Welcome to the Deep Dive, where we cut through the noise and get straight to the insights you need to be truly well-informed. Have you ever stared at a tax form and just felt, well, that familiar wave of dread?
Oh, yeah. All those boxes, the complex language, it can feel like trying to decipher some kind of secret code.
Exactly. But what if one of those crucial forms didn't just demand compliance, but actually held the key to optimizing your tax outcomes?
Hmm.
What if understanding it could unlock, significant tax savings or deferrals you didn't even know were possible?
That's precisely what we're here to explore today. We're cracking the code on IRS Form 8949, officially titled Sales and Other Dispositions of Capital Assets.
Okay.
Our mission isn't just to explain what goes where, it's to give you a strategic understanding of its essential connection to Schedule D. And maybe most importantly, how properly reporting your investment activities can translate into real financial advantages for you.
That's right. If you've sold stocks, bonds, cryptocurrency, real estate that wasn't your main home, or even, say, inherited property, then this deep dive is absolutely for you.
Definitely.
Think of this as your personal shortcut to being incredibly well-informed about a really critical and, let's be honest, often misunderstood part of your tax filing. We're going to try and demystify it and show you how to leverage this knowledge.
Sounds good.
Let's unpack this.
So let's kick things off with a fundamental question. What exactly is Form 8949?
Yeah. What's the core job here?
At its core, its primary role is actually quite simple. It's your detailed ledger for reporting every sale and exchange of capital assets you've made throughout the year.
A ledger, okay.
Imagine it as a meticulous logbook for all your investment transactions.
And it's so much more than just a simple list, isn't it? It feels like it does more work than that.
It absolutely does. Form 8949 serves a crucial reconciliation function. Think of it as a bridge between your records and what the IRS already knows or thinks it knows about your transactions.
Ah, okay. So it's about matching up.
Exactly. See, when you sell an investment like stock or maybe some real estate, your broker or the closing agent typically sends you, and the IRS, a Form 1099-B or a Form 1099-S.
Right, those 1099s.
Those forms report the proceeds, the sales price of your transactions. Form 8949 is where you report those same proceeds directly from the 1099 right into column D.
Okay, column D. Got it.
And if your broker reported your cost or basis to the IRS, that also goes on the form, specifically in column E.
Okay, so proceeds in D, basis in, matching the 1099.
Ideally, yes. But the real power of this form, and honestly where the optimization really starts, is in ensuring that your numbers match up accurately.
What if they don't? What if the 1099 is wrong?
That happens. Often, the information on your 1099-B might not perfectly reflect your true tax situation. Maybe it doesn't include, say, selling expenses you paid, or the basis is incorrect for some specific reason we'll get into.
Huh?
If any correction or adjustment is needed to those amounts reported on your 1099-B or 1099-S, that's where column G becomes, well, your best friend.
Column G, the adjustment column.
Exactly. This column is your opportunity to fine-tune those numbers, ensuring your tax liability is based on the precise figures, not just what some third party reported. It's about accuracy.
So who exactly needs to wrestle with this form? Who's filing this?
For individuals, it's actually a pretty broad group. It covers most significant investment activity.
Like what specifically?
You'll definitely need Form 8949 if you've sold stocks, bonds, mutual funds, or, cryptocurrency.
Okay, the usual suspects.
Right. Or perhaps you've sold a piece of real estate that wasn't your main home, like maybe an inherited vacation property or a rental property. That goes here too.
Gotcha.
Also, if you've had gains from certain involuntary conversions of capital assets, that means your property was taken or destroyed, but it wasn't a business asset and not due to casualty or theft, this form applies.
Interesting.
And importantly, if you've had a non-business bad debt, someone owes you money personally, not business-related, and you can't collect.
That goes on 8949.
Yep, as a short-term loss. Or if a security you own became completely worthless during the year, that's reported here too.
Okay, worthless stock, bad debts.
It also comes into play for more specialized situations. For instance, if you're a non-resident alien individual with a gain or loss from selling a partnership interest that's connected to a U.S. trade or business, you'll use Form 8949.
Okay, more niche cases.
And for those engaged in, let's say, more forward-thinking investment strategies, like electing to defer a capital gain by investing it into a qualified opportunity fund, or QOF,
Ah, the QOFs. We hear a lot about those.
You'll definitely be using Form 8949 for that election, and naturally, when you eventually dispose of those QOF interests down the line, this form is central to reporting that event as well.
Makes sense. What about married couples filing jointly?
If you're a joint filer, you and your spouse have some flexibility. You can choose to list your transactions on separate Forms 8949, maybe one for each of you, or you can combine them all onto one set of forms.
Doesn't matter which way.
Not really, as long as the grand totals from all those Forms 8949 ultimately get carried over and included correctly on your Schedule D. That's the key part.
Okay. And you mentioned other entities use it too, not just individuals.
Yeah, while our deep dive today focuses primarily on individuals, it's worth a quick mention that corporations, partnerships, estates, and trusts also utilize Form 8949 for similar capital asset transactions.
So it's pretty universal in the tax world for this stuff.
It really is. It's a universal tool for reporting these types of dispositions. This is particularly true for things like worthless securities, certain foreign partnership interests, and those qualified opportunity fund elections we just touched on.
Right.
For example, a corporation reporting its share of gain or loss from a partnership will often do so on Form 8949. This really emphasizes that this form is a central piece of the puzzle for capital asset reporting across various entity types.
Okay. Now we keep mentioning Schedule D. How do these two forms, 8949 and Schedule D, actually work together?
Think of Form 8949 as the highly detailed, itemized receipt for every single one of your capital asset transactions, really granular.
The nitty-gritty detail.
Exactly. While Schedule D is the final summary, the big picture of your investment wins and losses for the year. Form 8949 is always filed with Schedule D. They're a package deal.
Got it. So 8949 provides the backup for Schedule D.
Precisely. Schedule D's primary role is to aggregate and figure your overall net capital gain or loss, pulling those totals directly from all those individual transactions you meticulously listed on Form 8949.
But Schedule D does more than just total up the 8949s, right?
Oh, yes. It also pulls in gains from other specialized forms like Form 625B2 for installment sales or Form 4797 for dispositions of business property.
Yeah.
It's also where you report capital gain distributions you receive from mutual funds, any capital loss carryovers you might have from previous tax years.
I love carryovers, yeah.
And for individuals, it's where your share of capital gains or losses that are passed through from partnerships or S corporations land.
So 8949 is truly the foundational detail.
It is. It feeds into the bigger picture on Schedule D, which then ultimately determines your overall capital gain or loss for tax purposes.
Okay, now here's where it gets really interesting. You mentioned something about maybe not needing Form 8949 sometimes.
Yes, and this is a fantastic potential time-saving strategy for many listeners. There's a crucial exception, often called Exception 1, where you might not need to file Form 8949 at all for certain transactions.
An exception. I like the sound of that, like the IRS giving you a shortcut.
Pretty much. If your broker has done all the heavy lifting and everything is straightforward, you might get to skip the detailed listing.
How does that work? What are the conditions?
This can be a huge time saver. You can completely bypass Form 8949 for specific transactions and report them directly, in summary, on Schedule D Line 1A for short-term gains or losses, or Line 8A for long-term.
Okay, directly to Schedule D, but what's the catch?
There are a few important conditions. First, you must have received a Form 1099-B that clearly shows your basis was reported to the IRS. It's usually in Box 1A.
Basis reported. Got it.
Second, you don't need to make any adjustments to that basis or the type of gain or loss reported. So boxes 1F or 1G on your 1099-B must be blank.
No adjustments needed. Okay.
Third, the ordinary box in Box 2 of the 1099-B isn't checked. And critically, the transaction isn't related to one of those qualified opportunity fund deferrals we talked about.
So simple transaction, basis reported, no adjustments, not ordinary income, not a QOF.
If all those stars align for a transaction, yes, you can skip Form 8949 entirely for that specific transaction and just include it in the summary totals on Schedule D.
Wow. So if your trades are simple, your broker reported everything correctly, and you don't need any special adjustments, the IRS essentially says, great, just tell us the total on Schedule D.
That's the gist of it. This exception dramatically simplifies the process for many straightforward investment sales.
That's a perfect example of how understanding these rules can save you significant time and effort during tax season. That's like optimization of your time.
Exactly. It's administrative relief.
So what does this all mean for you, the listener? Form 8949 isn't just another dry tax document you have to fill out.
Not at all. It's your detailed ledger for capital assets, ensuring transparency with the IRS by reconciling your personal records with what your brokers reported. That's important for avoiding issues.
And
More importantly, it lays the crucial groundwork for your overall investment tax picture on Schedule D. Getting it right here is absolutely foundational for accurate tax reporting and, as we'll delve into much more, unlocking some very real tax optimization opportunities.
it's the first step to truly taking control of your investment tax liabilities. Now that we've established what Form 8949 is and why it matters, let's peel back the layers on some essential concepts. These are absolutely critical to understanding how to report your investments accurately and, frankly, how to potentially minimize your tax bill.
Absolutely. Foundational stuff here.
First up, what exactly is a capital asset? We use that term a lot.
Right. Broadly speaking, a capital asset is almost anything you own for personal use or for investment purposes.
Like what? Give me some examples.
Well, the common ones are stocks, bonds, mutual fund shares, also your personal residence, collectibles like art or antiques, jewelry.
Okay. What about things like crypto?
Yes, and even your digital assets, which we'll definitely discuss in more detail shortly. While the full exhaustive definition is a bit more technical, and you can find it in the Schedule D instructions.
The fine print.
Exactly. For most of us, if you own it for investment or personal pleasure and it's not something you sell as part of your regular business inventory, it's probably a capital asset.
Okay, that makes sense. Now, this next part feels like the most critical distinction for your tax bill. Understanding the difference between short-term and long-term capital gains and losses.
You nailed it. This isn't just an academic classification. It fundamentally determines how your gains are taxed, which is huge.
And the critical line in the sand is generally 1 year, right?
Precisely. If you held the property for 1 year or less before selling it, any gain or loss is considered short-term.
1 year or less is short-term.
Correct. If you held it for more than 1 year, it's long-term.
More than 1 year long-term. How do you figure out that holding period exactly?
You start counting on the day after you acquired the property and you include the day you disposed of it.
Day after acquisition, up to and including the day of sale?
Yep. So, for example, if you bought a stock on January 10th, 2023, and sold it on January 10th, 2024, that's exactly 1 year. That gain or loss is short-term.
Okay, 1 year exactly is still short-term.
Correct. But if you sold it just 1 day later, on January 11th, 2024, now you've held it for more than 1 year and it becomes long-term.
Wow, 1 day makes a big difference. Why is this distinction so paramount?
Because short-term capital gains are typically taxed at your ordinary income tax rates. Those are the same rates that apply to your salary or business income.
Which can be pretty high.
They can be significantly higher than the preferential, often much lower, tax rates applied to long-term capital gains.
Ah, okay. So long-term gains get better tax treatment.
Generally, yes. This is a primary area for tax optimization, simply managing your holding periods strategically. Sometimes waiting just a few more days or weeks to sell can result in substantial tax savings if it pushes you into long-term territory.
That's a great tip. Now, are there exceptions? Special rules? It's the tax code after all.
Of course. Always special rules. For instance, inherited property is always reported as long-term, regardless of how long you actually held it before selling it.
Always long-term for inherited assets. That's huge.
It's a significant advantage for heirs. It allows any gains to be taxed at those potentially lower long-term rates, even if you turn around and sell it the day after you inherit it.
Wow. Okay, what else?
Also, remember those non-business bad debts we mentioned? Someone owes you money personally, you can't collect. That's always treated as a short-term capital loss.
Always short-term loss. Got it.
And while your Form 1099-B from your broker might help by indicating the holding period in Box 2, sometimes it's blank, or it might have a code X.
Meaning what?
Meaning the broker doesn't have that information or isn't required to report it. In that case, you absolutely need to rely on your own meticulous records to determine the correct holding period. Don't guess.
Records. Okay. Any other weird rules?
Well, it's also worth noting, mainly for those with more complex investment structures like certain partnership interests, especially in the private equity or hedge fund world, there's something called Section 161.
Section 1N61.
Yeah, it can recharacterize certain long-term capital gains as short-term, even if held over a year. It typically applies to carried interests for fund managers.
Okay, so probably not for the average investor, but good to know complex rules exist.
Exactly. It's a highly nuanced area, but it's an important reminder that special rules do exist and can alter the expected holding period classification. The takeaway here is always be mindful that your specific situation might have unique rules, and when in doubt, check your records or maybe consult a tax professional.
Definitely. Okay, now let's talk digital assets. This is where it gets really interesting for a lot of people navigating crypto, NFTs. How does the IRS view this stuff?
Yeah, this is a hot topic. The IRS has been quite clear. They define a digital asset pretty broadly as a digital representation of value recorded on a cryptographically secured distributed ledger or any similar technology.
So basically everything. Bitcoin, Ethereum, NFTs.
Pretty much. That definition includes anything referred to as convertible virtual currency, cryptocurrency, and non-fungible tokens, or NFTs. It's a wide net.
And here's the crucial point for tax purposes, right? How are they treated?
The IRS treats digital assets as property. This is the fundamental concept you need to grasp.
Property, not currency.
Not currency for tax purposes.
Yeah.
Property. This means that all the general tax principles we apply to traditional property transactions, like selling stocks or maybe a piece of art, apply equally to your crypto and NFT dealings.
So things like basis, holding period.
Exactly. You need to establish your cost basis, determine your holding period for short-term versus long-term gains or losses, and report those gains and losses, typically on Form 8949.
It's not funny money in the eyes of the IRS.
Definitely not. It's property, plain and simple.
Can you give us an example? Make it real?
Sure. Let's use one from the IRS's guidance. Imagine you bought 1 unit of, let's call it digital asset A, for $1,000 maybe 3 years ago.
Okay, 1K basis, held long term.
Right. Today, you decide to exchange it for 1 unit of digital asset B. And at the moment of that exchange, digital asset B has a fair market value of $3,000.
So you trade your 1K basis asset for a 3K asset.
In that scenario, you've just realized a $2,000 long-term capital gain on the disposition of digital asset A, $3,000 value received minus a $1,000 basis, because you held A for more than 1 year.
And that $2,000 gain is taxable.
Yes, it's
Yeah.
a taxable event, just as if you'd sold a stock for a $2,000 profit. You report it on Form 8949.
Okay, what about earning crypto?
Good question. Let's consider another scenario. Maybe you're a self-employed graphic designer, and a client pays you with 1 unit of digital asset A. At the time you receive it, it has a fair market value of $10,000.
Okay, so you get paid $10 in crypto.
First, you have to correctly report that $10,000 as self-employment income on your tax return for that year. That's step 1.
Income first. Then what's your basis in that crypto?
Your basis is the $10,000 fair market value you reported as income. Now, let's say 2 months later, the value of that same digital asset climbs to $12,000 and you decide to sell it for cash.
Sell for $12 K basis was $10.
In this case, you now have a $2,000 short-term capital gain. Your basis was the $10 income you recognized, and you held it for less than a year, only 2 months.
Short-term gain, tax at ordinary rates.
Exactly. Understanding this property treatment and its implications basis, holding period, reporting requirements is absolutely key to accurate reporting and knowing your potential tax liability in this rapidly evolving digital asset space. Don't ignore it.
Okay, let's unpack what is often the most misunderstood yet incredibly powerful concept in capital gains taxation: basis. You mentioned it a few times.
Yes, basis is fundamental.
This is where you, the taxpayer, truly have the power to accurately report your investment and potentially significantly reduce your taxable gain. I feel like this is where people can really make mistakes.
You're absolutely right. Sloppy records here or just misunderstanding basis can literally cost you thousands in unnecessary taxes.
So what is basis, simply defined?
Basis is simply the amount of your investment in property for tax purposes. For something you buy, it's typically its original cost, including any commissions or other acquisition expenses you paid.
Original cost plus buying expenses.
Generally, yes. And knowing your accurate basis is absolutely fundamental because it's the number you subtract from your proceeds or sales price to determine your actual gain or loss on the sale.
Proceeds minus basis equals gain or loss.
That's the formula. Without an accurate basis, you cannot accurately determine your taxable gain or properly claim your full loss if you sold at a loss.
Which is why meticulous record keeping isn't just a good idea.
It's a financial imperative. Your records should precisely show the original purchase price, including those commissions. You also need to diligently track any increases to bases over time.
Increases. Like what?
Like the cost of capital improvements you make to a property, think putting a new addition on a rental house. Or maybe a original issue discount, OID, you included in your income from a bond you hold. That increases your basis in the bond.
Okay, improvements, OID.
And it's not just increases, you also need to track decreases to basis.
Decreases. How does basis go down?
Think about depreciation you've claimed on an investment property over the years. That reduces your basis. Or non-dividend distributions you received on stock. These are sometimes called return of capital. They effectively return part of your original investment, so they lower your basis. Stock splits also affect your basis per share.
Depreciation, return of capital.
Okay, all these adjustments, both increases and decreases, ensure your basis accurately reflects your current investment in the property at the time you sell it.
What if you've lost records? Especially for stocks bought long ago.
That can be tough. A smart first step is always to contact your broker or the mutual fund company. For covered securities, generally stocks acquired after 2010, your broker is required to track and report the basis to the IRS, and it should be in Box 1E of your Form 1099-B.
Covered securities. That helps for newer purchases.
It does. The IRS even partners with companies offering tax software that can help track adjusted basis for securities. You can often find information about that on the IRS website, maybe irs.gov file.
Good tip. Now, you mentioned basis isn't always just cost. This is where it gets complex, but also where tax optimization can begin, right?
Absolutely. Navigating the more complex basis scenarios is key. Your basis isn't always the simple original cost you paid. It can vary significantly depending on how you acquired the property.
Like how?
For example, if you received property as a gift, or if you inherited it, or acquired it through a tax-free exchange, or maybe an involuntary conversion, or even after a wash sale. Each of these methods has its own specific set of rules for determining what your starting basis truly is.
So the acquisition method dictates the basis rules.
Precisely. Understanding these nuances is critical for accurate reporting and potentially maximizing your tax position.
Let's hone in on inherited property again. You said the holding period is always long-term. What about the basis?
Right. For property you inherit, your basis is generally the fair market value, FMV, on the date of the decedent's death.
FMV at date of death. That's the step up in basis people talk about.
Exactly. It's often referred to as a step-up because usually the property has appreciated. This can be a huge tax benefit for heirs. It essentially wipes out any capital gains tax on the appreciation that occurred during the decedent's lifetime.
Can you give numbers on that?
Sure. Let's say your grandmother bought stock for $100 many years ago. When she passed away, that same stock was worth $10,000. Your basis as the heir is $10,000, not her original $100.
Wow.
So if you then immediately sell that stock for $10,500, your taxable gain is only $500, the appreciation since death, not the $10,400 that would have been taxed if the step-up didn't exist.
That's a massive difference. A huge tax saving.
It really is. However, there's a crucial catch and a potentially significant penalty to be aware of, especially involving large estates.
Oh, what's the catch?
If the executor of the estate filed an estate tax return, Form 706, and provided you with a Schedule A to Form 8971, this form reports the final estate tax value of the assets you inherited.
Okay, Form 8971, Schedule A.
If that schedule indicates the property you inherited actually increased the estate tax liability for the estate, you are required by law to use a basis on your income tax return when you sell that is consistent with that final estate tax value. You can't claim a higher basis.
Consistent basis reporting. Makes sense. What's the penalty?
And here's the kicker. There is a hefty 20% penalty if your reported basis on Form 8949 is higher than the amount shown on that Schedule A, and that property increased the estate tax liability.
Ouch. 20% penalty for inconsistent basis.
Yeah. So while the step-up is generally a powerful tax-saving mechanism, accurate, consistent reporting, especially when Form 8971 is involved, is absolutely vital to avoid painful penalties.
Good warning.
Yeah.
Okay, beyond the acquisition method, you mentioned basis gets adjusted during the holding period too. Can we revisit some examples of increases?
Sure. You need to increase your basis for any capital improvements you make to a property, think a new roof or a significant renovation on a rental house. Not just repairs, but actual improvements.
Capital improvements, not just maintenance.
Right. For certain debt instruments, like bonds bought with original issue discount, OID, you increase your basis each year by the amount of OID that you've included in your gross income. OID is basically like interest that's built into the bond's price.
So including OID income increases basis.
Okay. Similarly, if you hold a bond bought at a market discount and you elect to include that discount in income currently, that also increases your basis. And for compensatory options, like stock options from your employer, your basis generally increases by any amount you included in income when you received or exercised the option.
Got it. These adjustments are vital for ensuring you don't accidentally overstate your gain when you eventually sell.
Exactly. You want credit for all those additional investments or income inclusions.
And on the flip side, the decreases. You mentioned depreciation.
Right. Your basis is decreased by things like depreciation, amortization, and depletion that you've claimed or were allowed to claim over the years, usually on business or investment property.
Okay, depreciation lowers basis.
Non-dividend distributions on stock also reduce your basis, remember? That's a return of your capital. They can't take your basis below zero, though.
Can't go below zero.
And if you buy a taxable bond at a premium, more than face value, and elect to amortize that premium, the amortization amount reduces your basis in the bond each year.
Bond premium amortization.
Okay. These decreases ensure your basis accurately reflects the remaining undepreciated investment you have in the property. It directly impacts your taxable gain or loss calculation when you sell. For instance, another niche case. If you sell property to a charity at a market price.
Well, part sale, part donation.
Exactly. You actually have to allocate your original basis between the portion that was sold and the portion that was contributed as a donation. That allocation affects both your gain-loss calculation on the sale part and your charitable deduction amount.
Complex stuff. What about simpler methods for tracking basis, especially for stock?
Yeah, for identical shares of stock, particularly in mutual funds or maybe shares acquired through dividend reinvestment plans, DRPs, that are held with a custodian, you might be able to use the average basis method.
Average basis, how does that work?
Instead of tracking the basis of each specific share purchased at different times and prices, this allows you to average the cost of all identical shares you own in that account. It simplifies record keeping significantly.
That sounds much easier for mutual funds.
It often is, and if you use this method and your Form 1099-B happens to show an incorrect basis, you don't panic. You'll simply use code B in column F of Form 8949 and make the necessary adjustment in column G to correct it.
Code B for basis correction. We'll come back to codes.
We will. And finally, it's important to understand the practical difference between covered and non-covered securities we touched on earlier.
Covered versus non-covered. Remind me.
For covered securities, again, generally stock acquired after 2010 or certain debt instruments and options acquired after 2013, your broker is required to report the basis to the IRS on Form 1099-B in Box 1. This simplifies things for you because the broker does the tracking.
Okay, covered means the broker reports basis.
Right. However, for non-covered securities, typically those acquired before those dates, the responsibility for providing the correct basis falls entirely on you, the taxpayer. The broker might report the proceeds, but basis recording is optional for them, and often they just leave it blank or indicate it's non-covered.
So for older stocks, I definitely need my own records.
Absolutely. This is yet another area where meticulous records are paramount to ensure you're not paying tax on a larger gain than you should be, which directly impacts your bottom line tax bill.
Okay, let's circle back to this idea of basis then. It's clearly, as you said, often the most misunderstood part of capital gains.
It really is.
But it's fundamentally where you have the power to accurately report your investment. Getting this right can significantly reduce your taxable gain, leading to real tax savings.
That's the key takeaway. Think of it. If you incorrectly report a lower basis than you should have, maybe because you forgot about reinvested dividends or couldn't find purchase records,
You'll show a higher gain on paper.
and pay more tax than necessary. Conversely, accurately accounting for all those increases, like improvements or OID, and decreases, like return of capital or depreciation, to your basis is a foundational step in effective tax optimization for your investments.
This isn't just about compliance. It's about making sure you don't overpay Uncle Sam.
Precisely. It's about accuracy and fairness.
All right, let's get practical. Let's dive into the form itself, Form 8949. How is it structured? How do we actually fill this thing out?
Okay, boots on the ground time. The form is pretty intuitively structured into two main parts. Part 1 is dedicated to reporting your short-term gains and losses, remember, assets held 1 year or less.
Part 1, short term.
And Part 2 is for your long-term gains and losses assets held more than 1 year.
Part 2, long term. Makes sense.
Within each part, you'll notice there are 3 checkboxes at the top, box A, B, and C for short-term, Part 1, and box D, E, and F for long-term, Part 2.
Okay, A, B, C in part 1, D, E, F in part 2. What do those mean?
They relate to whether you received a Form 1099-B for the transaction, and if so, whether the basis was reported to the IRS.
Connecting back to the 1099 reporting.
Exactly. For example, Box A, short-term, or Box D, long-term, are used for transactions where you did receive a 1099-B and basis was reported to the IRS. Box B, short-term, or Box E, long-term, are for when you got a 1099-B but basis was not reported. And Box C or F are for transactions where you didn't receive a 1099-B at all.
Okay, so you need to sort your transactions based on the 1099 reporting first.
That's the key. You need to use separate copies of the relevant Part I or 2 for each different box type you have transactions for. So you might have a Part I with Box A checked and another Part I with Box B checked if you have both types of short-term transactions.
Separate pages for each box type. Got it. You only check one box per page.
Correct. Only one box checked per Part 1 or Part 2 page you submit.
Okay, starting with line 1 on the form, what goes here generally?
Line 1 is your starting point for reporting pretty much all sales and exchanges of capital assets. You report everything here, even if you didn't receive a Form 1099-B or 1099-S for it.
Report everything, unless. Is there an exception?
Well, the main exception we often see is for the sale of your main home. If you meet the criteria to exclude all the gain, you might not even need to report it on Form 8949 at all. You might report it directly on Schedule D, or sometimes not at all, depending on the specifics.
Okay, main home sale is special. What else goes on line 1?
It's also where you'd report losses from the partial disposition of certain depreciable property held for investment, but not used in a trade or business, like maybe selling off part of some equipment held purely for investment.
That sounds specific.
It is. Interestingly, if you had a gain from that same type of partial disposition, it would actually go in a different form entirely, Form 4797, which deals with business property. So it's about understanding where each specific transaction's gain or loss correctly belongs.
Okay. Now, you mentioned earlier something really important about personal property losses.
Yeah.
Can we revisit that? This seems like a common trap.
Absolutely. This is a crucial point that directly impacts your tax liability and prevents mistakes. Losses from the sale of personal use property are almost always not deductible.
Personal use property,
Like what?
like selling your personal car at a loss, or maybe that antique dresser you inherited, or some old sporting equipment you sold online via eBay or Facebook Marketplace. Things you own for personal enjoyment, not investment.
Okay. And you might get a 1099-K for those sales sometimes. Exactly. If you hit certain transaction volume or dollar thresholds on those platforms, you might receive a Form 1099-K reporting the proceeds.
So the IRS knows you got money, but you actually lost money on the sale. How do you handle that on Form 8949?
This is where Form 8949 helps you communicate the situation correctly. If a 1099-K report proceeds from a personal property sale that actually resulted in a loss, because you sold it for less than you originally paid for it, you should still report it on Form 8949. This reconciles with the 1099-K the IRS received.
Report it, but you can't deduct the loss. So how?
You use the codes. Crucially, you'll use code L for non-deductible loss in column F, and then make a specific adjustment in column G. The adjustment amount will be a positive number equal to the amount of the loss.
So the adjustment cancels out the loss.
Precisely. It ensures the net gain or loss shown in the final column comes out to $0 for that transaction. This shows the IRS you received the proceeds reported on the 1099-K, but correctly identifies that the associated loss isn't deductible.
That's smart. It avoids confusion and potential flags on your return.
It's a key compliance step that prevents errors on your part and shows you understand the rules.
Okay, let's walk through the columns themselves, left to right. Column A, description of property. What goes here?
This is where you provide enough detail for the IRS to identify the asset. For stock, include the number of shares and the company name or ticker symbol.
Number of shares, ticker. What about crypto?
For digital assets, the IRS wants the full name or the abbreviated symbol, the exact units sold, for example, 0.5 Bitcoin, and if you have it, maybe a transaction ID number. Just be clear and consistent.
Be specific. Got it. Next, column B, date acquired.
For most stocks and bonds, this will be the trade date when you bought them.
Trade date acquired. What about inherited property?
If you inherited the property, a simple but important notation is to just write inherited in this column.
Just inherited. Why?
Because, as we discussed, inherited property is automatically considered long-term, regardless of your actual holding period. Writing inherited signals this special rule applies.
Ah, okay. That's efficient. What if you bought shares of the same stock on different dates? like dollar cost averaging.
If you sold a block of stock that you purchased on different dates, you can enter various here. However, you still have the responsibility to correctly separate the short-term and long-term portions of that sale onto the appropriate parts of Form 8 and 949, Part 1 or Part 2. Various doesn't skip that step.
Okay, various is allowed, but doesn't simplify the short long-term calculation. Column C, date sold or disposed of.
Similar to acquisition date, for most stocks and bonds, this will be the trade date of the sale.
Trade date sold. Pretty straightforward. Now column B, proceeds, sales price. This seems important.
It is. It's the starting point for your gain-loss calculation. Now, there are two scenarios here.
Okay.
Scenario 1. If you didn't receive a Form 1099-B or 1099-S for the sale, in this case, you'll report the net proceeds here. That means the gross sales price minus any selling expenses you paid, like commissions or closing costs.
No 1099, report net proceeds. Scenario 2.
Scenario 2. If you did receive a Form 1099-B or 1099-S, this is a critical rule for compliance and avoiding IRS matching notices. You must always report the exact proceeds amount shown on that official form in column D. Don't change it here, even if you think it's wrong or incomplete.
Always report the 1099-B proceeds amount in column D. But what if it is incomplete? Like it doesn't show my selling costs?
Don't worry. You absolutely don't lose out on accounting for those costs. This is precisely where columns F and G come into play again. You report the 1099-B figure in...
Okay. Report the gross from 1099-B, then adjust for costs using code E and G. That makes sense.
It's a direct, common-sense tax-saving strategy. Correctly accounting for selling expenses reduces your net proceeds and thus your taxable gain.
What if, for some weird reason, my actual proceeds were more than what was on the 1099-BS?
In that less common case, you should report the correct higher proceeds amount in column D. The goal is always accuracy.
Okay, and what was that niche case about savings bonds?
Oh, right. In a very specific scenario, if you somehow erroneously received a 1099-B for what was simply a return of your original investment on a non-transferable obligation, like maybe cashing in certain savings bonds at maturity for exactly what you paid.
So, no actual gain or loss.
Right. To show this correctly, you'd report the proceeds amount shown on the incorrect 1099-B in both column D proceeds and column E basis. This results in a zero gain loss in column H, effectively canceling out the phantom transaction reported on the 1099-B.
Clever. Okay, next is column E, cost or other basis. We spent a lot of time on why basis is crucial.
Indeed. This is where you put that all-important basis figure. Generally, it's your original cost, adjusted as needed.
But as we discussed, it's not always just cost, right?
Correct. Your actual cost might not always be your tax basis if the property was acquired by gift, inheritance, through a wash sale, etc. In those cases where you're using a basis other than cost, the instructions sometimes suggest attaching a separate explanation detailing how you arrived at that basis figure.
Attach an explanation for non-cost basis. Got it.
And remember, your basis put in column EE must be properly adjusted for all those things we talked about: non-dividend distributions received, OID included in income, bond premium amortized, compensatory option income recognized, depreciation claimed, capital improvements made.
All those adjustments need to be factored in before putting the number in column E.
Yes, that gives you your adjusted basis. Now, if you're dealing with a covered security where the basis was reported on your Form 1099-B in Box 1.
Use the basis shown on the 1099-B?
Generally, yes, you start with the basis shown on the 1099-B in column E, but, and this is key, if you know that reported basis is incorrect for some reason.
Then what? I thought we had to report what was on the 1099-B.
You report the incorrect basis from the 1099-B in column E, just like you reported the proceeds from the 1099-B in column D. Then you use column G to make the correction. We'll get to the specific code for that.
Okay, report the broker's number, then fix it. This ensures the final taxable gain or loss in column H accurately reflects your tree investment and your correct basis.
Exactly. Columns D and E often start with the 1099-B figures for reconciliation, and column G is where you make things right.
This brings us to columns F, code, and G, amount of adjustment. You called these the power tools for tax optimization.
They really are. These two columns working together are specifically designed to allow you to explain why the gain or loss might be different from a simple calculation of proceeds minus basis. They let you correct errors from your 1099-B or account for specific tax rules like exclusions, deferrals, or disallowed losses.
So column F is the reason code. Column G is the dollar amount of the adjustment.
Precisely. And if more than one code from column F applies to a single transaction, maybe you have selling expenses and an incorrect basis.
Then what?
You enter all the applicable codes alphabetically in column F with no spaces or commas between them. Then you calculate the net dollar adjustment needed and enter that single net amount in column G.
Okay, multiple codes possible, but only one net adjustment number in G.
Correct. Let's focus on some of the most impactful codes, the ones that really connect to tax-saving strategies or are critical for compliance.
Yeah, let's break down these codes. Which ones really matter?
Okay, first, let's group some by function. How about codes related to correcting broker errors and ensuring accuracy? These are fundamental for not paying tax on phantom gains.
Good category. What's key here?
Code B for incorrect basis. This one is incredibly common and absolutely critical for calculating your gain or loss accurately. If your 1099 GB shows an incorrect basis,
Which happens?
it does. If the basis was reported to the IRS, meaning it's a Box A or Box D transaction, you still put the incorrect 1099B basis number into column E. Then you use the specific worksheet for basis adjustments found right in the Form 8949 instructions. That worksheet helps you calculate the precise adjustment amount needed for column G.
So there's a worksheet for code B adjustments.
Yes, it walks you through it. The goal is to make column H the final gain or loss correct, reflecting your true basis. Let's use that example again. Sale for $1,000. Your actual correct basis was $100, but your 1099B erroneously reports a basis of $900 in Box 1E.
Okay. Incorrect basis reported.
You put $1,000 in D proceeds and the incorrect $900 in E basis. Just looking at D minus E gives a gain of only $100, $900. But your real gain should be $900, $1,100.
So you need to add $800 to the gain.
Exactly. So you put code B in column F and a positive $800 adjustment in column G. Now, column H will calculate correctly. $1,000 D, $900 E plus $800 G, $900 gain. Perfect.
Wow. That adjustment using code B is crucial for accuracy. It prevents you from understating your gain due to the broker's error, but more often it prevents you from overstating your gain if the broker reported too low a basis.
Precisely. It ensures you're taxed on your actual gain, not an incorrect one. This can save you significant money.
Okay, what's another key code in this accuracy category?
Code E for selling expenses or option premiums that weren't already reflected on your 1099B or 1099S proceeds amount.
We touched on this. Direct reduction of gain, right?
Yes, this is a direct reduction to your taxable gain.
Yeah.
If your broker reported the gross proceeds in column D but didn't subtract your commissions or other selling costs, you use code E. You enter a negative amount in column G for the expenses you paid. That negative number directly reduces your taxable gain calculated in column H.
Simple but effective tax saving. What about option premiums?
Conversely, if you received option premiums related to the sale that weren't included in the proceeds reported on the 1099-day B, you'd use code E and enter a positive adjustment in G to increase the proceeds. It ensures all parts of the transaction are accounted for.
Okay, codes B and E are vital for correcting the numbers. What about codes for exclusions and deferrals, the major tax saving?
Right. This is where you claim some potentially huge tax breaks. Let's start with the big one for homeowners. Code H for main home gain exclusion. This is potentially one of the largest tax breaks available, allowing many homeowners to exclude hundreds of thousands of dollars of gain from tax.
The $250K, $500K exclusion.
Exactly. If you sold your main home at a gain and you qualify to exclude some or all of it, up to $250,000 for single filers, $500,000 for married filing jointly generally, and you have to report the sale on 8949 for some reason, maybe you got a 1099S, you enter the excluded non-taxable portion of the gain as a negative number in column G.
Negative number for the excluded gain. Example.
Okay, the compelling example from the IRS instructions. Imagine you sold your main home for $320,000. Your basis was $100,000. You also had $20,000 in selling expenses that, let's say, weren't reflected on the 1099-S you received. You qualify to exclude the maximum $200,000 of the gain. Maybe you're single.
Okay, $320K sale, $100K basis, $20K costs, $200K exclusion. How does it look on 8949?
In column F, you'd actually put EHE for the selling expenses and H for the home sale exclusion.
Both codes, EH.
Yep. And then in column G, you'd enter the total negative adjustment. That's the negative $20,000 for the expenses plus the negative $200,000 for the exclusion. So you put negative $220,000 in column G.
Minus $220K in G.
Yeah.
What does that do to the final gain in H?
Let's calculate column H. $320,000 D precedes $100,000 E basis plus negative $220,000 G adjustment equals $0 gain. This strategically uses the codes to apply both the expense deduction and the exclusion, legally wiping out the taxable gain and saving you a substantial amount of tax.
That's powerful. Code each is huge. What else in exclusions deferrals?
Code Q for Qualified Small Business QSB Stock Exclusion, another potentially significant tax-saving opportunity if you invested in certain qualifying small business stock and held it for more than 5 years.
QSB stock held over 5 years.
You might be able to exclude a large portion, sometimes up to 100% of the capital gain when you sell it. If you qualify, you enter the excluded amount as a negative number in column G. This directly reduces your taxable capital gain, sometimes to zero. It's a powerful incentive designed to encourage investment in small businesses.
Code Q for QSB exclusion, also a negative in G. What about deferring gains?
Code RR for rollover of gain. This code applies if you're electing to postpone gain recognition from certain types of transactions. The most common example is rolling over gain from one QSB stock investment into another QSB stock within 60 days, but there are other specific rollovers too.
So postpone the tax instead of excluding it.
Exactly. You enter the postponed gain as a negative number in column G. This isn't a permanent exclusion like H or Q, but it's a fantastic tax deferral strategy. It allows you to reinvest the entire proceeds, including the deferred gain, and potentially let that capital grow further before the tax bill eventually comes due when you sell the replacement property.
Code R for rollover deferral. Negative EAN. Are there others?
Code X for exclusion of gain from DC zone assets or qualified community assets. These are less common, specific geographic-based incentives. But if you happen to qualify for these exclusions, similar to the main home exclusion, you enter the excluded gain amount as a negative number in column G to claim this valuable tax saving.
Code X for special zone exclusions. Also negative. Okay, now the big one. QOFs. Code Z.
Code Z for Qualified Opportunity Fund, QOF deferral election. Yes, this is perhaps one of the most talked about tax deferral strategies in recent years for investors looking to reinvest capital gain into designated economically distressed communities.
How does Code Z work on the form? It sounds complicated.
It involves a couple of steps. First, when you elect to postpone an eligible capital gain by investing it into a qualified opportunity fund within 180 days of realizing the gain, you report the original gain transaction, e.g. the stock sale that generated the gain, normally on its own row on Form 8949, just like any other sale.
Report the original sale first. Then what?
Then you use a completely separate row on Form 8949 specifically for the deferral election itself. This second row is just for the QOF deferral.
A separate line just for the deferral. What goes on that line?
On this special deferral row, you enter the Employer Identification Number, EIN, of the QOF you invested in into column A. You put the date you made the QOF investment in column B. Column C, date sold, D, proceeds, and E, bases are all left blank.
EIN in A, investment date. In B, skip C, D, E,
Yep.
then codes.
Then you enter code Z in column F. And here's the key. You enter the amount of the capital gain you were deferring as a negative number, in parentheses, in column G.
Code Z and the deferred gain as a negative in G. What about short-term versus long-term?
You make the deferral election on the corresponding part of Form 8949. If the original gain you're deferring was short-term, the Z entry goes on Part 1. If it was long-term, it goes on Part 2. The original character of the gain, short-term or long-term, is retained and will matter when you eventually recognize that deferred gain years later.
Okay, character is retained. This seems powerful, but requires careful tracking.
It absolutely does. This is a significant deferral opportunity, allowing you to potentially delay paying tax on that invested capital gain for years, possibly until the end of 2026. And it also requires you to file another form, Form 8997, annually while you hold the QOF investment and also when you eventually dispose of it.
Form 8997 for QOF tracking. Wow.
Yeah, QOFs have ongoing compliance. Depending on how long you hold the QOF investment itself, be 5, 7, or 10 years, you might get additional tax benefits like a basis step up on the QOF investment or even tax-free appreciation on the QOF investment itself. It's truly a strategic investment and tax planning tool directly enabled by that Code Z entry on Form 8949.
Okay, those are some major tax saving and deferral codes, HQRX, SEED. What about the last category, non-deductible items and special situations? These sound like compliance codes.
Exactly. These are mainly about ensuring you're reporting things correctly according to specific rules, often preventing you from claiming deductions you're not entitled to.
Like Code L.
Code L for non-deductible loss. As we discussed with selling personal use property at a loss, if you have a loss that isn't deductible under the tax rules, Other common examples might include losses from hobby activities. You must still report the transaction, especially if you got a 1099 for it, but then you enter that non-deductible loss amount as a positive number in column G.
Positive number for code L. Why positive?
Because adding back the loss amount cancels it out. If column D minus column E resulted in a negative number, a loss, adding that same number back as a positive adjustment in G brings the final result in column H to 0. It effectively zeroes out the loss for tax purposes, ensuring you're not claiming non-allowable losses and maintaining proper compliance.
Got it. Positive adjustment makes the loss disappear from the total. What about wash sales? Code W.
Code W1 for wash sale. This is really important for accurate loss reporting on stocks and securities. If you sell a security at a loss and then you buy substantially identical stock or securities within 30 days before or 30 days after that sale.
The 61-day wash sale window.
Right. That loss is generally non-deductible under the wash sale rule. You still report the sale transaction, but you enter that disallowed loss amount as a positive number in column G, similar to code L.
Positive adjustment for code W2.
Yes. This prevents you from claiming an artificial loss while essentially maintaining your economic position in the same security. The good news is the disallowed loss isn't lost forever. It typically gets added to the basis of the replacement shares you bought. So code W ensures correct current year reporting while preserving the loss for the future.
Adds the loss to the basis of the new shares. Okay, what's code N?
Code N for nominee. This is used if you received a 1099-B or 1099-SS because a transaction technically passed through your account or name, but you were just acting as a nominee for someone else. The money wasn't actually yours.
Like holding stock for a minor child.
That could be an example. You report the transaction as shown on the 1099 you received, but then you use code N and make an adjustment in column G so that the final gain or loss in column L comes out to 0. You'd adjust a gain to negative or a loss to positive. This ensures you're not paying tax on someone else's gain or improperly claiming someone else's loss. You then typically issue the actual owner their own Form 1099.
Code N zeroes it out for the nominee. Makes sense. Code T.
Code T for incorrect type of gain or loss. This is used if your Form 1099-B incorrectly classifies the transaction. For example, maybe it labels a short-term gain as long-term or vice versa. Or maybe it incorrectly reports a capital gain as ordinary income, though that's less common on 8949 itself.
So the 1099 box is wrong about short versus long term.
Right. In that case, you simply report the transaction on the correct part 1 for short term, part 2 for long term of Form 8949. You usually just put code T in column F and a 0 adjustment in column G unless other adjustments are also needed. The act of reporting it on the correct part of the form fixes the classification issue.
So code T signals the broker's classification was wrong, but reporting on the right page fixes it.
Exactly. It ensures your capital gains are ultimately taxed at the correct rates. Ordinary rates for short-term, preferential rates for long-term.
Wow. That's a lot of codes, but understanding them seems absolutely critical.
It really is tactical. Columns F and G are truly your control panel for fine-tuning your capital gain and loss reporting. Knowing these codes and how to apply them correctly can literally translate into hundreds or thousands of dollars saved in taxes or properly deferred. It can mean the difference between paying your fair share and significantly overpaying, or missing out on valuable exclusions and deferrals.
This is precisely why a deep dive into this level of detail really pays off.
Absolutely. And don't forget, the IRS even provides helpful worksheets right there in the Form 8949 instructions for some of the trickier adjustments, like the basis adjustments, code B, accrued market discount, code D, and certain contingent payment debt instruments, code O, which is for other adjustments not covered elsewhere. They try to guide you through the calculations for column G.
Good to know there are worksheets. Okay, after all that, we finally arrive at column H, the gain or loss.
Yes, the bottom line for each transaction, this is the final calculation, and mathematically it's simple. It's just column D, your proceeds, minus column E, your cost or other basis, plus or minus whatever adjustment amount you entered in column G.
EE plus G.
That's it. So using our earlier example, if you have $6,000 in proceeds, D, $2,000 in basis, E, and maybe a negative $1,000 adjustment in G, perhaps for selling expenses using code E.
6K, 2K, 2K.
Your gain in column H is $3,000, or if basis was $8,000, $6,000, D $8,000, and our incorrect basis example.
Right, the $1,000 proceeds, D, $900 incorrect basis E, plus $800 positive adjustment. The formula works.
This is the final calculation, your bottom line for that specific transaction. All the previous meticulous steps, the codes, the adjustments, ensure this number in column H is accurate. Exactly. It ensures column H reflects your true tax obligation or deductible loss, subject to limitations, for that specific sale or exchange. It's the culmination of all your careful record-keeping and understanding of these complex but important rules.
Okay, we've meticulously walked through the columns. Now let's talk about smart reporting strategies. You mentioned some exceptions and provisions that can genuinely save time and effort. Can we revisit those?
Absolutely, because filling out line by line can be tedious if you have many transactions. The first, and for many investors, the most impactful efficiency is that exception 1 we introduced earlier, potentially skipping Form 8949 altogether for certain transactions.
This is the holy grail, right? The shortcut.
It really is for streamlining tax prep if you meet the specific conditions. For many ordinary investors with straightforward trades, this is a huge time saver.
Remind us again, how does it work?
If your transactions meet all the criteria, you can simply aggregate those straightforward sales and report the totals directly on Schedule D. Short-term totals go on line 1A, long-term totals go on line 8A.
And you bypass Form 8949 entirely for those specific transactions.
Completely. You don't list them individually on 8949, and you don't even need to attach a separate statement detailing them.
Wow. Okay, quickly, what were those strict conditions again?
You must have received a Form 1099-B for the transaction, and that 1099-B must show that the basis was reported to the IRS. Box 1E is filled in.
Got it. 1099-B received, basis reported.
Critically, no adjustments are needed to that reported basis or the type of gain loss. So boxes 1F, accrued market discount, or 1G, wash sale loss disallowed on the 1099-D must be blank.
No adjustments needed. Boxes 1F, 1G blank.
The ordinary box, box 2 on the 1099-B, isn't checked, and the transaction is not related to electing deferral into a qualified opportunity fund, QOF.
Not ordinary, not QOF.
If a transaction meets all those conditions, you can group it with other similar qualifying transactions and just report the summary totals, total proceeds, total basis, net gain loss, directly on Schedule D, lines 1A or 8A.
That's fantastic. It saves a ton of data entry, a real administrative tax saving, like you said.
It really is designed for that.
Okay, what if you have lots of transactions, but they don't qualify for Exception 1? Maybe basis wasn't reported or you have adjustments to make. Is there still an efficiency option?
Yes, there is. That brings us to Exception 2, using an attached statement. This is very helpful for active traders or anyone with a high volume of transactions that don't meet the strict criteria for Exception 1.
Exception 2, attached statement. How does this work?
Instead of listing each and every single transaction on a separate row of Form 8949, which, as you can imagine, could literally result in pages and pages of entries for an active trader.
Yeah, that would be painful.
You can prepare and attach your own detailed statement to your tax return.
My own statement. What needs to be on it?
That attached statement must contain all the required transaction details for each individual sale. The description, dates acquired and sold, the proceeds, the basis, any applicable adjustment code from column F, and the adjustment amount from column G. It needs to be in a clear format, similar to the layout of Form 8949 itself. Many brokerage statements already provide this level of detail in a downloadable format.
Okay, attach a detailed statement. Then what do you put on the actual Form 8949 itself?
On the actual Form 8949, you'll enter summary totals from your attached statements. You use one summary line on Form 8949 for each brokerage statement or grouping. For instance, in column A description, you might write something like broker name C attached statement.
Okay, refer to the attachment. What about the other columns?
You would typically leave columns B date acquired and C date sold blank on that summary line. You'd enter code M, which stands for multiple transactions reported on a single row, in column F.
Code M for summary line.
Yep. And then you'd put the aggregate totals for proceeds, basis, total adjustments, and the final net gain or loss from that entire attached statement into columns D, E, G, and H, respectively, on that one summary line.
So one line on Form 8949 summarizes potentially hundreds of trades from the attachment.
Exactly. If you have statements from multiple brokers, you would use a separate summary row on Form 8949 using code M for each broker's aggregated totals from their respective attached statements. This is incredibly useful for active traders, transforming a potentially massive data entry task into a much more manageable summary reporting process.
That sounds like a very practical solution for high-volume traders, Exception 2.
It is. Now, there's also something called a special provision mentioned in the instructions. Is that relevant for individuals?
Generally, no. It's important for our individual listeners to know that the special provision, which allows certain entities to report summary totals without detailing each transaction or attaching a statement, is rarely applicable to individual taxpayers. Who does it apply to then?
It typically applies only to certain corporations, partnerships, securities dealers, and other entities that are exempt from receiving Form 1099-B in the first place, and even then, only if they have more than 5 transactions to report for that specific part, box A, B, C, D, E, or F of the form.
Okay, so special provision is likely not for me unless I'm a specific type of entity. For most individuals, it's either Exception 1, Direct to Schedule D, or Exception 2, Attached Statement with Code M.
That's the practical reality for the vast majority of individual filers.
One last practical point. What about e-filing? If I use Exception 2 and attach a statement, how does that work electronically?
Good question. If you're e-filing your tax return and you choose not to report each and every transaction electronically within the software, maybe because you're summarizing using Exception 2, you might need to follow up by mailing a paper copy of your Form 8949 showing the summary totals with Code M and your detailed attached statement to the IRS. This is usually done with a cover form called Form 8453, U.S. Individual Income Tax Transmittal for an IRS e-file return.
So, e-file the return, but mail the backup statement separately with Form 8453.
That's often the procedure if the detailed transactions aren't included electronically in the e-file itself. However, this mailing step is not required for transactions that qualify for Exception 1, since they're just summary totals on Schedule D, or if you somehow qualified for the special provision. Your tax software should guide you on whether Form 8453 is needed based on how you entered the data.
Okay, good to check the software instructions on that. So these exceptions, 1 and 2, they aren't just obscure rules tax pros argue about.
Not at all. They're designed to genuinely save you, the taxpayer, time and effort during tax season, especially if you have many transactions.
Understanding if your trades qualify for Exception 1, for example, can dramatically simplify your tax filing process. It effectively gives you a tax saving through sheer efficiency and reduced administrative burden.
Absolutely. It's all about working smarter, not harder, with your tax reporting, while still being accurate and compliant. #tag outro. So, as we wrap up our deep dive into Form 8949, we've really covered a lot of ground. We journeyed from just understanding its foundational purpose, serving as your detailed ledger for capital asset sales, and meticulously reconciling with those 1099-B and 1099-S forms,
But the reconciliation piece is key.
to demystifying those crucial concepts like what actually counts as a capital asset, the critical distinction between short-term and long-term holding periods, and navigating the often tricky but vital world of calculating your correct basis.
And most importantly, I think we've seen how accurate reporting, especially through the strategic and informed use of those powerful codes and adjustments in columns F and G, can lead to really significant tax optimizations.
Absolutely. We saw how it enables exclusions like the main home gain exclusion using Code H and deferrals like using Code Z for qualified opportunity funds. These directly impact your bottom line taxable income.
It's about moving beyond just filling out boxes on a form to actively managing your financial outcomes based on the tax rules, from correcting incorrect basis figures your broker might have reported to claiming every legitimate selling expense. Understanding this form truly empowers you to take control.
What stands out to me most is how something that might seem like just mundane compliance, filling out this form correctly, can actually open doors to incredible financial leverage.
How so?
Well, each correctly applied code, like H for the home sale exclusion or Q for a QSB stock, each accurately calculated basis, making sure you're not overstating your gain. It isn't just about following rules. It's about making sure you're not overpaying tax. It's about ensuring you capitalize on every legitimate tax advantage the system offers you.
It's truly about financial literacy transforming into financial power.
Well said.
Absolutely. So maybe the next time you look at your investment portfolio, remember, it's not just a collection of assets you own. It's a dynamic tapestry of transactions. And each transaction has potentially profound and nuanced tax implications.
Right.
By taking the time to truly understand forms like 8949, you're not just complying with the rules. You're becoming the active manager of your financial story, meticulously optimizing for every opportunity the tax code provides.
It puts you in the driver's seat.
Which leads to our final thought for you to mull over. What other hidden opportunities for tax optimization might be waiting for you to uncover in your financial life simply by looking a little deeper, asking more questions, maybe about the other forms you file or the financial decisions you make every day?
A great question to ponder. We hope this deep dive has empowered you with the knowledge and hopefully the confidence to navigate your investment tax reporting with greater insight and strategic intent next tax season.
If there's another complex financial topic or maybe a confusing tax mystery you'd like us to unpack in a future deep dive, please let us know. Until next time, keep digging deeper.